yours.
Thank you very much, Hans. Thank you also to Hans Nielsen, who's somewhere on a train in Sweden, I hear. Good afternoon, dear colleagues, and good morning to those of you who are further east. Before I start with the content, allow me to honor my peers and colleagues who have contributed to this work, with Marcus Barreit from Switzerland, Miguel Casas from Belgium, Suran Chatterjee from Hungary, respectively India, Johan Kohlen from Belgium, Albert Hilser from the Netherlands, and Rüdiger Lose from Germany, Sarah Mitchell and Mark Robertson from Canada, and Diana Ergotwas from Hungary again. So all of us together worked on the topic of building deep energy retrofits using dynamic cash flow analysis and multiple benefits to convince investors. Let me quickly give you an introduction. Why are we addressing this topic? You will probably agree that deep energy retrofit is one of the meaningful strategies to reduce fossil fuel consumption and thus CO2 emissions. Nevertheless, investment demand is a number that I can hardly imagine. BPIE has made an assessment and come up with 1,000 billion euros until 2050. There are other estimates that are all in that range. Ultimately, it's a very high number. And that means we have no chance to get this money from public budgets. Public budgets can help, public budgets can guide deep energy retrofit, but in order to come up with this substantial investment, we will need private sector investments in order to achieve significant results. And that has large implications to the kind of analysis we need to do to deep energy retrofit, meaning it's got to be a bankable type of analysis. And we'll come to that in a little moment. What were our goals? We want to understand the economic and also the financial viability of deep energy retrofit project cash flows, and what are the sensitive parameters in such a business case. Secondly, our goal is to find a language that we can use to communicate with investors. And those investors happen to be mostly people with a financial background, less so with a technical background that you can report on technical efficiencies. So finding the right language to get in touch with those partners that we'll need on our journey towards deep energy retrofit is a very important goal. And then we're using a concept that most of you will be familiar with, the multiple benefits of energy efficiency concept introduced by the IEA in 2014, the beautiful flower that you've all probably seen. Our question more particularly is, can some of these benefits be captured on the microeconomic level? So what can we find and actually assess and quantify, and what can we integrate into a business case to make that deep energy retrofit business case more attractive? And then, of course, there are some policy implications, which is not the primary focus of this analysis, but the findings do give some guidance towards policy. And this is the last slide before we actually go into the content. What is our method of approach? We did a case study on an office building deep energy retrofit to a passive house, which was done in Germany. And we have a very detailed set of numbers on investment costs and so on, and savings of that particular business case. But it is a case study. It's not a huge sample. And how representative that really is a point that we can certainly discuss together. And then we applied a investment analysis, dynamic investment analysis, to that particular case by using a life cycle cost benefit model. And we were distinguishing between project, equity, and debt cash flows in order to derive the respective economic and financial KPIs. With regard to the multiple benefits, we basically did a study on existing literature and also a good practice research with a particular focus on the benefits on the participant level. So that's the level, the project level or the microeconomic level. And in order to classify these multiple benefits, we came up with a classification code, which I will show you later on. And we're suggesting to introduce a new term that we labeled as multiple project benefits to distinguish from the multiple benefits more on the societal level. I would also like to mention that the values that I will be showing you, the quantifications, are definitely conservative. So you'll be seeing ranges, and even those ranges are conservative ranges. So they may well be higher in reality, but we wanted to be careful, as we always should be. So here's the case. You can see an office building that was retrofitted from this on the left side to this on the right side. And to give you an idea of what that building not only looks like, but the size is about 1,700 square meters with an energy baseline of 45,000 euros per year. And there's certainly a whole lot of buildings of these kind around, so it's not particularly outstanding in that regard. The CAPEX for the energy retrofit was roughly €500,000, and if you divide that by the square meters, you come up with 330 euros per square meter. And that's a number you should keep in mind because we'll need it to compare with our benefits that we're seeing later on. What should also be mentioned is that this number does not contain the so-called anyway cost that would have been needed for a normal retrofit. And that accounts for about 170 euros. So if you put those together, you'll come up at about 500 euros. We were calculating only with the energy-related cost of 330. If you look at the savings achieved, we're finding almost 90% savings in heat cost, which is a typical value for a passive house standard. We'll find rather lower savings for the electricity, which has two reasons, one of them being the lighting retrofit we've done, and of course all the pumps and so on have been replaced with high efficiency. But compared to the initial building where there was no air conditioning system, that is an extra electricity demand due to the HVAC that was added during the passive retrofit. So this is the case, and we're moving now into the economic analysis. And what you're seeing here, and I'll try to point that out to you, is on the, I'm grabbing the, that doesn't seem to work. Well, maybe you can see my pointer. So here on the y-axis we have positive cash flows. On the below zero we have negative cash flows, meaning expenditures, and this is the project duration over 25 years. We'll be following the gray line, which is your cumulative project cash flow, and you're seeing a large expenditure. This is your 500,000 expenditure for the CAPEX. And then this is slowly increasing over time with the annual savings adding on. Up until year 14, then you see a dent. That dent is reflecting the cost of a major overhaul of the technical system. And then it continues to climb, crossing the zero line in about year 20 and ending at about 150,000 euros positive cash flow. So what does that mean? That means that all expenses are covered within the project duration of 25 years, and there's actually a surplus of 150,000 from the savings. So that might indicate this case is economical. There's more revenues than cost. If you go into this cash flow analysis in a little more detail, you can derive so-called KPIs, and I've put them somewhere below on the right side here, and you can see that the IRR, the internal rate of return, is at 1.9%. The net present value is slightly negative of 60,000 euros, and the payback time is 21 years. If we take a look at these indicators, we're finding that this IRR of 1.9% means somebody would need to be willing to invest into this project and accepting a return on this investment of just 1.9%, which, depending on your expectations, may or may not be a lot. If you compare it and discount it with an average WACC for a project finance, we're actually coming to a negative net present value, slightly negative. So these numbers indicate that if you have very low expectations on your return, yes, this might possibly be reaching a black zero. If you now look at the equity cash flow, which is your dark blue, that's the share that you have to put in from your own money, typically somewhere between 25 and 30%. You'll find that this equity cash flow remains negative for most of the time. Then for this recapitalization, year 15 of the HVAC system, you're needing to actually put in some more equity. And then this is slightly starting to increase, and after year 20, when the debt service is repaid, then slowly your equity can get paid back and you're crossing the zero line just before the end of the project. So from an equity standpoint, again, it's maximum a black zero. If you had any expectations on return on your equity, this is not feasible, and that's reflected in the 0.8 million euros of net present value. If we take a look at the sensitivity analysis, you're seeing your variations of input parameter, plus to the right and minus to the left, and the influence of that to your internal rate of return of the project cash flow. So we're starting at 1.9%, which is the crossing line of all the lines here. And now we can answer the question, what will happen if, for example, you want to achieve at least your WACC, your weighted average cost of capital, which is your horizontal line at 3% here. And that means you have two options. Either you would need to increase your savings or the value of your savings by roughly 10% here, or you could also try to reduce your CapEx, and that value is at about 11%. So we're seeing that in order to achieve the profitability limit of the WACC, we would need about 10 to 15% more either savings or less in investment. That I would call is the gap towards reaching a profitability line. So you can interpret that as good news or bad news. You might say, well, it's not profitable, so it's not good. I would rather say you can refinance about 85% of the investments just from future energy cost savings. So that could be seen as good news. Let us take one more look at the investment analysis, and this is a representation of the so-called debt service, which you can see reflected here in red for the interest and blue for your principal payments. So you can see you have a 20-year tenor model here. You have a grace period of 2 years where there is no principal payments. So this is your annual debt service obligation towards your bank or your debt service provider. And the green line in comparison is your so-called cash flow available for debt service. That's the cash flow, the net cash flow that remains after you have deducted operational cost from your revenues. And now you can compare that cash flow available to your debt service. And the bankers typically do that in a so-called debt service coverage ratio, which you see plotted here on this right side. And in order to meet your debt service obligation, you would need at least a ratio of 1. Then you have just enough in your project account to repay your debt and principal. And you're seeing that this cannot be achieved until about year number 10. There's not enough cash flow available for debt service. And after that, that ratio gets above 1. But that means for the first 10 years, you cannot refinance your debt service from the project savings alone. And since banks are rather conservative, they will probably want a margin. They would not accept a debt service coverage ratio of 1.0, but they would accept one of possibly 1.2. And if you look at that line here, this last one I'm just showing you, you're seeing that not before year 16 there is enough cash flow available to require a bank's minimum debt service coverage ratio. So overall, you're seeing that the loan life coverage ratio is 1.18. That might indicate, yes, there is enough cash generated over the entire project duration of 25 years, but there's definitely a shortage of cash available in the first 10 years, maybe even in the first 15 years. And that's a clear indication that this project, even though over the entire project duration there's enough revenues earned, there's a net positive cash flow, this is not financeable or bankable with the annual cash flows. So our next point was to look at what could be additional revenues from multiple project benefits. And let me quickly guide you through the method of approach. What we're doing is we're distinguishing the benefits on the society or utility level from the benefits on the participant level. And within the participant level, we found over the course of the project that we'll need to distinguish between different types of investors. And we're coming up with 4 categories, which is your property developer, your occupant owner, your lessor owner, and your tenant. And when we do the analysis later on of the findings, you will see that the distinguishing between those 4 different types of actors is very, very meaningful, and it's actually a representation of the split incentive that is all well known to you. As a next step, what we did, we were designing a classification grid for the different types of benefits, and you see on the y-axis the relevance to the business case. So the more relevant a case is, the more it is up high, and the less relevant it is, the lower it is. And on the x-axis, you're seeing the difficulty of quantification. And we're actually starting to put our findings in these different quadrants. And to give you a more tangible example, we're finding maintenance cost savings from deep energy retrofit. We're finding rental premiums and sales premiums. All of these 3 were rather easy to quantify, and they were relevant for the business case. If we're moving down, we're also finding greenhouse gas emissions and the respective carbon price. Again, these were rather easy to quantify, as a matter of fact, very easy to quantify, however, not very relevant to the business case because of the low carbon prices, which we will see when we do the quantification. And then we're finding a very relevant indicator, which is your employee productivity or your work productivity, as it's called in the literature. And we'll find that this is highly relevant to the business case, however, difficult to quantify. And then there's others that you can see here in the lower right corner, difficult to quantify and not relevant to our business case. So this is sort of an approach that may be helpful for classification of different types of benefits. Which actually brings us to the results. Here is a list of valuated deep energy retrofit multiple project benefits. And in the order that you're seeing it here, we're looking at work productivity increase, we're looking at a rental income increase, we're looking at a building sales price increase, CO2 savings, maintenance cost savings, and then energy cost savings we have distinguished over the 2 project periods. So the one within our project period within 25 years, and then there's additional energy cost savings beyond the project period until the technical lifetime of, in our case, 40 years of that deep energy retrofit. So this is the list of benefits we've been able to quantify, and this is what you see in the next slide. Here is a quantification of all these benefits, and let me guide you how this table is constructed. It's first important to understand the metrics. The metrics here is actually in euros per square meter and year. And it means that this figure is directly comparable, for example, to construction cost, but also to operation cost in the building sector. So it's basically a conversion of figures that we found in the literature to a concrete business case, and then instead of putting it per building, we were coming up with this metrics of per square meter and year. And to the right, you see another figure per square meter and year, sorry, euros per square meter, but this is now the net present value. So we're taking the time series of the cash flows and discounting it to the net present value over 25 years, and this is what you see in the annotations here. 25-year project term with an assumed 1.5% yearly price increase and a WACC of 3% used as a discount rate. And also I put as a reminder here the figure of the CAPEX for the energy retrofit. And now we can take a look at those figures. And I would suggest that we take a look at the right column here. And we're seeing for the work productivity increase, we're seeing a number that is between 219 and 439. So that means per square meter, the value of work productivity increase over the 25 years discounted to today's values is 219. If you look at the rental income increase, we're looking at somewhere between 25 and 134. Building sales prices are, of course, a one-off because it's sold only once. That's between 100 and 260. The CO2 savings have the value of between 6 and 79. The 79 is a value from our colleagues in Switzerland, which give a higher value to CO2 than most of us in the emission trading system. The maintenance cost savings you're seeing here, and then the energy cost savings. So what we can learn from this table is a first indication of relevance. Which of those quantified benefits are relevant to the business case and which are not? And as you're all aware, the CO2 price is low enough to not be relevant, to not matter, to not be able to influence any investment decisions. And that's the same thing that we're seeing here with the 6 euros. When you come up with 79, well, then we'll see that has a much higher value than, or much higher relevance, of course. Maintenance cost is also not very relevant, but it's starting to be relevant. What is very interesting is that your building sales price increase is way below your additional cost. So if you take the figure of 100 of the lower value and compare that to your 330, you're seeing, well, apparently the additional price that an investor can get on the market for a highly insulated building is not reflecting his cost. And the same is true for your rental income increase. You are not getting enough of additional rents in order to justify the higher investment for the deep energy retrofit. However, when you look at the work productivity, that seems to be a very relevant figure. And here the 355 of the energy cost savings is a relevant figure, of course. And we were seeing, yes, it's a project, it's a net positive cash flow in the end, slightly above the 330. So the same figure as or the same comparison as we saw in the cash flow analysis early on. And the last step I want to do now is actually allocate those benefits to different beneficiaries. So here on the left side, you're seeing the same table as before, and on the right side, we're now distinguishing between different types of beneficiaries. The first one being the property developers, and the property developer, his only extra benefit is when he sells the project. So his total down here is in the range between 100 and 260. And I already explained in the last slide that this is probably not enough of an incentive to build highly efficient buildings or to renovate to deep energy retrofit standards or passive house standards, because you're not getting your money back on the market as it currently is. And that's what we're all seeing in the building sector. Our second perspective is the occupant owner, and then we have the lesser owner. So these three are all different types of owners, and then we have the tenant. And if we now continue on the bottom line, we've already talked about the property developer, and now we take a look at the occupant owner. And that was one of the surprises in the analysis, that the occupant owner has a total of benefits that's somewhere between 780 and above 1,000. So a factor of about 2.5 to 3 above the initial investment cost. And the reason for that is he actually profits from a higher productivity. But he also profits from the CO2 savings, from the maintenance cost savings, from the energy cost savings now, and the ones that are in the near or in the future. So a very, very high benefit and benefit cost ratio of between 2.5 to 3. And I think in reality, we're seeing exactly this when we look at companies that invest in high quality buildings for their employees. They're putting a lot of money because they're realizing that work productivity is of a very high value to them. And if they can increase the cost of labor or decrease the cost of labor by just 1%, that is in a similar order of magnitude compared to the energy cost savings. Shifting to the lesser owner, the picture is very different. The lesser owner has just the benefits of a little bit higher rental income. When he sells the building, yes, he will benefit of that, but he also has a smaller benefit of the maintenance cost savings. So in total, there's nowhere near a match to his additional costs for deep energy retrofit. And the last surprise was actually when we were looking at the tenant case. And for the tenant, we're seeing a rather high benefit number of in total between 550 and 750. So again, a factor of somewhere 1.8 to 2.5 higher than the initial investment. And that is, he is profiting from the higher productivity as well as from the energy cost savings. And that might have some rather interesting implications on the question of, is it justified to increase rents in rented buildings after they have been renovated? And this analysis indicates it surely is, and it's still beneficial to the tenant. So that is one of the policy findings that we were actually being surprised to find, but that's our findings. So this brings me to my discussion and conclusions. The first point being beyond engineering economics. Cash flow model, the cash flow model that we built is actually a very solid ground for a deep energy retrofit business case analysis, but also for project structuring. And by project structuring, I mean the allocation, where to put resources, to find the relationship between an optimal investment level and the related savings, and so on. And also for financial engineering, which shares of equity are needed, what expectation on the equity can be satisfied, but also questions like what kind of loan structurings are we needing on the debt service side, so for example, grace periods and so on. Second point, bridging the language gap. We found that this language is a language that potential investors do understand, and we also found that in terms of policy design, this can give some very helpful hints where support is actually needed. The third point is a point that some of you will find maybe even frustrating, and it says cash flows from future energy cost savings are not a standalone or a bankable business case, not even with the 25-year investment horizon. And this is relating back to what I said when I said, is it good news or bad news? Is the glass half full or half empty? I would say the glass is 85% full. And that's the fourth point. The good news is cash flows can co-finance investments substantially, up to 85% in our case study. And a rather small co-financing is needed from other sources. But bad news, not a standalone business case by itself. And I guess that's what we're also seeing in the market. It doesn't take off by itself. More good news from the multiple benefits field or the multiple project benefits field. Deep energy retrofit can and will generate tangible and quantifiable results on the project level, and we were looking at the cases of higher rents, the higher real estate values, lower maintenance costs, CO2 savings, and higher work productivity. And you will remember that the orders of magnitude or their relevance is actually highly different. And I don't think I need to repeat that. Sixth point, these multiple benefits contributions can make a business case more attractive. And if you look at the rather small gap that's missing, the 15% that we were identifying in our case study in order to break even with the WACC expectation, I think it's fair to say that the order of magnitude of the multiple benefits is definitely high enough to match that missing gap. And another point I would like to make here is that I think as energy efficiency communities and people, we need to find strategic allies, what I called it here, for DER programs. It is probably beyond the just energy efficiency perspective, but together with the energy productivity perspective, together with the health perspective, and so on, that we're needing to find allies to drive deep energy retrofit programs. The split incentive is a very relevant problem that we're seeing that was revealed by the very different allocations of the benefits to those different types of investors. And the surprising thing for me was tenants actually do have a high possibility to profit from deep energy retrofits. And on a political level, this might lead to this discussion of shouldn't they also contribute for paying for these retrofits. And our last point is more of a general nature, saying that the policymakers should probably use cash flow analysis of the type that we did in order to really find out where support is needed. And in particular, if we follow our initial statement of saying this huge amount of investment sum that we're facing, which will need mainly private sector involvement, means that we will need to facilitate that private sector investment. And that has implications on the, for example, Eurostat guidelines and all other types of regulations that allow or that influence the risk perception of private sector investments. So I will end here, say thank you once again to my peers for contributing to this work, and look forward to your questions, remarks, and further collaboration.